a lot of that depends on the dollar and the course of course, monetary policy. You know, certainly the gap between U.S. and non-U.S. markets so far this year has been enormous, and a lot of that can be attributable to the divergent path of earnings growth. You know, earnings in the U.S. are growing at 23%. Earnings elsewhere are growing at about 8% and decelerating. So there's a very large gap. Of course, the story is the tax cuts boosting the U.S. picture, while the rest of the world does not have that. And meanwhile, we have the Fed in tightening mode. That tightens liquidity conditions. So we've had this tale of two markets. But the dollar looks like it's maybe peaking here. And, you know, the market thinks the Fed's going to raise rates 3 more times and probably end the cycle by mid-2020. While the ECB, of course, as you know, is going to start tapering soon and maybe even start shrinking its balance sheet by 2020. So the market starts to look past that policy divergence, and if the earnings picture starts to narrow, then certainly there's room for non-U.S. markets to start outperforming again. But I don't think we're quite there yet, but a lot will depend on the dollar and liquidity conditions here in the coming few months.
Torsten, what's your view on the strength of the U.S. economy now and whether it does support continued tightening to the upside surprise levels from the Fed?
It does indeed. We do worry quite a bit about the uptrend in inflation. The Fed has an inflation target of 2%, and we're literally at that 2%, and we've been coming up through that for the last 6-8 months. So it's pretty clear that the Fed will continue to raise rates. The only issue is that the rest of the world, and in particular emerging markets, are doing relatively poorly. So that's why the U.S. is benefiting in many ways, in particular U.S. rates, from the problems in Turkey, Argentina, and even some of the problems also in Europe and elsewhere, including in Japan, that the weakness abroad is sucking dollars into the U.S. market, both in rates and in equities.
Do you think that whether it's the ECB, the UK, Japan, any of the other developed markets can surprise investors as to when they start to tighten policy relative to the US?
Yeah, one would expect the emerging market issues to start subsiding later this year. Also, Brexit continues, of course, for a while longer. But at the end of the day, there is an end date even to that, and we'll get hopefully some more clarity on that going into next year. And finally, of course, on Europe, we also expect that to begin to subside as we do begin to see both QE end later this year. So generally, we do expect the whole global economy should generally do well.
Embedded in that assumption, though, about emerging markets is that the dollar is capped, correct?
Well,
even with the rising interest rates here in the United States, that the dollar won't go too much higher. I mean, that will be a major obstacle for EM.
That's true, but the issue is also that several emerging markets have sort of idiosyncratic issues, and Turkey and Argentina are sort of separate stories that really have very little to do with much else. And that's sort of creating some panic attacks among many investors around the world who are then saying, well, okay, maybe US rates is better, despite the risks of the Fed raising rates, as Winfried was saying in here, and potentially the risk also of inflation overshooting.